Welcome, friends. In this edition of live virtual classes, ICAI Ashish Gupta, Joint Director Board of Studies, welcomes you all. As in this series, there is a hybrid mode wherein we request the student that they go through the recorded lectures already available on the ICAI website, BS Knowledge Portal, and then we shall take up a brush up of the concept in these classes. So today's topic, we hope you must have gone through the lectures of the topic of the foreign exchange exposure and risk management. And now our faculty CA Parvesh Agi will revise the session topic in this today's session in the next class. So student, you are requested to clear your doubts in this session because you are, and even after say last 20 minutes, we shall open the session for the students. Okay, so student can even verbally ask the question. Of course, we have a separate chat facility available with you, so you can post your question on that also. So, student, with this, without taking your much time, I hand over the show to CA Parvesh Agi. Parvesh Agi, sir, welcome. We welcome you, and
Thank you so
now
much.
if you please start your session. Thank you.
Yeah. Thank you, Ashish, for introducing me. And as students, we he has already told you that we'll be covering this topic, foreign exchange exposure and risk management. Now, we all know that this topic is little tricky and it requires, a lot of understanding of the basics. So we will start with the basics and then finally move on to the important questions. So to begin with, we are talking about that foreign exchange risk is intrinsic part. It is an intrinsic part of doing international business. So it is, part and parcel of doing international business. When you're dealing with foreign exchange, you take that risk of, the fluctuation in the foreign currency. So the values of major currencies constantly fluctuate against each other, creating income uncertainty for your business. So when you're doing business and you are exposed to foreign currency, so it can affect your income, okay, and thereby affect your bottom line, and which is you may not like so much. So you would like to hedge that these kinds of risks. So we'll understand later on how do we do that. So if you look at the chart, USD versus INR over the last 1 year, now there are various currencies like US dollar, euro, Japanese yen. We have pound, sterling. I mean, so many currencies are there in the world. But let's take USD INR, which is USD happens to be the major currency of the world. Almost like 50% of the trade in the world happens between USD or any other currency pair. So if you look at the last 1 year chart, you will find that this graph is showing, there's a lot of fluctuation happening between US dollar versus rupee. Sometime, the dollar started at around, say, close to about, 81.82 at the beginning of the year and closed at 83.70. If you look at, overall, there was a 1% appreciation of a dollar in the whole year. But this was not a smooth appreciation. So there was a time when the rupee also appreciated and the dollar appreciated, but the dollar has appreciated and more over the 1 year term, which has given a 1 year appreciation to the dollar. The dollar always appreciate mostly in terms of rupee. So look at the 10-year chart now. If you look at the 10-year chart here, you will find that of course the dollar has appreciated over the last 10 years. Okay, and there is a smooth a bull run in case of a dollar versus rupee. But of course, it is not so linear. Sometimes the rupee has also appreciated. If you can see here, the rupee has also appreciated. The rupee started with the dollar started at 58 rupees and closed at 83, thereby giving on a 10-year basis a kind of an appreciation of dollar to the tune of 42%, which translates into roughly about 4% appreciation per annum, which is almost the interest rate differential between the two countries. If you look at India, the interest rate or the inflation rate differential. If you look at India, the interest rates are closely hovering around between 6 to 7%. We talk about the 10-year yield paper here, and in America, it's close to about 2 to 3%. The difference translates into 4%. Okay, but in the recent past, this difference has narrowed down to about 1.5% because there has been a lot of inflation and higher interest rates in US. Okay, so but here also, if you look at the 10-year chart, the rupee has also appreciated over the time, But most of the time, the dollar has taken a lead role, and we find the dollar has appreciated by approximately 42% over the last 10 years. So to begin now, many businesses like to eliminate this uncertainty by locking in future exchange rate, because we all know that the dollar, the euro, the pound, all these currencies, the yen, and all other currencies which we're talking about, they keep on, there is a lot of uncertainty in and we can lose, I mean, money, or in terms of bottom line, if we don't hedge these risks. So, but some businesses regard exchange rate movement as a profit opportunity, particularly when you talk about, the US versus, rupee, in terms of, the export businesses. So export houses, they earn their money mostly, like companies like Infosys, or, companies like TCS, they earn their major customers, I mean, lying in US and Europe. And they always thrive on, when the US dollar appreciates against the rupee. So for them, it is a profit opportunity. Now, the simplest risk management strategy for reducing foreign exchange risk is to make and receive your payment only in your currency. Now, how can we avoid risk, the foreign risk? The first is that if you raise a bill in rupee, I mean, if you are an Indian and you are selling goods outside, so make an invoice in terms of rupee and receive your money in terms of rupee, then you eliminate that risk. But you are passing that risk to the other party, which the other party may not like it. Okay, but of course, in the recent, we have seen, because of the the BRICS countries, they're trying to de-dollarize the trade. They want to reduce the dollar dependence. So a time will come that we will be able to raise invoices in our home currencies in future. So which will eliminate the risk. You might also lose customers to competitors who offer more currency flexibility, and your suppliers may be unwilling to accept payment is in what is to them a foreign currency. Now, if you ask them that you are going to raise your invoice in your rupee invoice, then many competitors may not be willing to take that, because if you offer them flexibility, then only they'll buy goods from you, or you can buy goods from them. So it's important that you have to take a risk in foreign currency. So you may therefore find that the competitive pressures force you to explore risk management strategy that helps manage your foreign currency risk more efficiently. So you have to devise ways how to manage those kinds of risks. Okay. So let's begin with the basic concepts. So in the meantime, I'll just check if you have. So I'm unable to join Zoom meeting as message displayed. Host has removed the meeting. Okay. So anyway, so I think I'm just going through the student's query now. Anyway, so we talk about the basic concepts. So let's look at this quote. $1 is equal to rupees 83.30, which is a current quote. Now, this is the quote which as an Indian we will look at if you want to buy a dollar. So this is a direct quote in India for US dollar, and it's very easy because we always look at this quote most of the time in our life. Okay, but this is a direct quote, and how do we know that it's a direct quote? For this quote to understand it's a direct quote, very easy, because we are tuned to this quote. But on the right hand side, which is rupee 83.30, so that reflects the home currency, the quote. Okay, so you look at the right side to understand whether it's a direct quote of which country. Okay, like when we do other quotes, then you will appreciate that. So now, if you look at 1 rupee is equal to so many dollars. So this would be an indirect quote in India for US dollars. But alternatively, this can be a direct quote in dollars this can be a direct quote for direct quote in India, which I said 1 rupee is equal to this thing. So it's an indirect quote in India for US dollar. So it will be a direct quote in US dollars for rupee. Okay. So so an American would always would like to buy a rupee. Okay, so they would like to know what is how much the US dollars they have to spend to buy 1 rupee. So this will become a direct quote in US for buying a rupee, whereas it becomes an indirect quote in India. So if you want to convert a quote from direct quote to indirect quote, then what we simply do is we do the reciprocal. So 1 divided by 83.30. So that means 1 rupee will be, if we solve this, it will be 1 rupee will be equal to $0.83. 01200. So this is the indirect quote in India, and it will be as well a direct quote in US for buying 1 rupee. So now look at another example. Okay, so the example is that, if you look at €1 is equal to so many dollars. Now this is a direct quote in which country? In US, because if you look at the right hand side, you'll find dollar. So a person wants to buy €1. Okay, so that means somebody's traveling or somebody's importing or exporting goods to a European country where the euro is prevalent. So American guy would like to know how much he has to pay for €1 in terms of dollars. So this is a direct quote. Now we can convert this as an indirect quote also. Okay, so this will be an indirect quote in US for euro. And for which country it will be a direct quote? And let me, can you answer this, students? If you're watching me, then try to answer. Which quote, in which country it will be a direct quote? So for that, you have to look at the right hand side. It is euro. So that means it is a direct quote. It is a direct quote for. So it will be, what will be the direct quote here? So this will be a direct quote for US, for euros in terms of US dollars. Okay, so that means if we divide 1 divided by the 1.0910, so we'll have $1 is equal to 0.916. So this will be a direct quote in a European country for buying $1. Okay, fine, or an indirect quote in USA for euro. So now there is another concept called American terms and European terms. Now this is a very important concept to understand, because this will help you to solve many of the problems, complicated problems in future. Now, an American term, we look at the dollar price per unit of foreign currency. So which means 1 rupee is equal to so many dollars. Similarly, €1 is equal to so many dollars. So whenever you find a dollar on the right hand side, which means it's a direct quote in America for buying the foreign currency. Okay, so a direct quote in the United States, or it can be an indirect quote outside the United States. So the both quotes can be converted, can be looked from different angle. So if the quote is like this, which is a direct quote in the United States, then we call it that it is written in terms of American terms. Okay, whenever you will have a dollar on the right hand side or any other currency on the left hand side, it is called American terms. But if you find a dollar on the left hand side and any other currency on the right hand side, we say it is the European quote. Okay, so this quote will be a direct quote outside US, whereas an indirect quote in United States. So this quote is an indirect quote in United States, but a direct quote outside the United States. For example, $1 is equal to rupees 80. We know it's a direct quote in India. $1 is equal to so many euro. We know that it's a direct quote in Europe, in European country. Okay, for example, Germany or France. So American terms and European terms. Now, what is the significance of this? We'll understand in our later slides.
Parvesh sir.
Yeah.
Sir, if any student is trying to join the Zoom, just you allow him.
Achha. So I'm not getting any kind of notification.
No, because earlier I think you may have disallowed anyone, the student.
No,
because...
I allowed, I allowed Mr. Mankar. Okay. I don't know.
Sir, you just allow them.
Okay. So I'll
just allow them. Every student is allowed on the Zoom now.
Okay. So I'm not getting any notification where I have to allow someone. So far. अभी मेरे पास कोई आया नहीं नोटिफिकेशन.
ओके, जब आए तो उनको आप कर दीजिएगा प्लीज.
ठीक है ना. Okay. Now we talk about the cross currency rate calculations. Now, what is this concept, cross currency? Let's understand. Cross currency rate is calculated by multiplying two exchange rates. So that means there should be two exchange rates. We multiply them. So we call it cross currency. Now, for example, USD is a base currency in one of the pairing and the quote currency in another pairing, in the other pairings. Okay, so we'll understand that. To understand what is the base currency and what is the quote currency, please look at, you can pause my video and look at what I have mentioned here. Okay, fine. So you'll be able to understand. So at the moment, I'm just skipping that, but because it's not so relevant. Okay. So look at, this quote. $1 is equal to rupees 83.30. Okay. So that means if you want to buy $1, you have to spend rupees 83.30 paise. Now we know that it's a direct quote in India for buying $1. Now, the other quote which is written as €1 is equal to so many dollars. So this is basically a direct quote in which country? In US for buying €1. Okay. Now, what you have to find? You have to find €1 is equal to so many rupees. Now, you know why this is when we arrive the price of the euro in terms of rupees by using these two quotes, we say it is a cross currency calculation. Now, why it is done and what is the big significance of this? Let's go back to history a little bit, about 20, 25, 30 years. Whenever we used to travel outside India, so we will get only dollars in India. Okay. Whether we are traveling to, US, whether we are traveling to England, whether we are traveling to Singapore, or whether we are traveling to, say, Germany, France. So we'll buy dollar in India and then go to that country where we are going and convert our, currency to the desired currency. For example, if suppose I'm going to Germany, so I'll buy dollars first and go to Germany and buy euro, convert my euro into dollars. So look at this. First quote is $1 is equal to 83. Okay. So I need to buy a dollar. Then I need to sell my dollar and buy €1. So both the currencies are giving you the same kind of a thing. So if you look at this, we have to find €1 is equal to so many rupees. So
Parvesh sir, Parvesh sir, but only just a pause only. I think there was one student, Mr. Mankar, is
uh,
trying to enter. So I request him, you please join again.
uh,
Okay, you will be
so I'll admit him. Yeah.
not even Ashok ji, their technical team is there. He
हाँ,
will make you join there. Okay,
अच्छा
please.
they will admit him. Okay.
Huh?
वो admit कर लेंगे अशोक.
Mr. Mankar, please try again from the link. Okay, sir, please continue.
Okay. So, if you look at this particularly the third box, which I was referring to, €1 is equal to so many rupees. Now, this, we know that this is a direct quote of, euro in terms of rupees. Okay. So a person who is, an Indian would like to know what is the price of €1 in terms of rupees. So that means if you're traveling abroad to Germany or France, or you are importing or exporting some goods from Germany or France or any other country where the euro is prevalent. So we would like to know the price of €1 in terms of rupees. So assume that you are traveling to Germany. So first you are going to buy a dollar. So the price of dollar is 83.30. Now we know that this is a European quote. Okay. And then the other quote, which is €1. So now you would be actually, buying when you go there and you have to buy a euro. So you will be looking at this price, this quote, €1 is equal to so many dollars. So you have reached to, Germany and you found that €1 is going to cost you $1. So that means you're going to buy a dollar and buy a euro and sell your dollar. Okay. So the second quote is American. So the first quote is European. The second quote is American. Okay. If it is given this way, then it becomes our job very easy. What we do is we simply multiply. So look at this, rupee upon dollar. Okay. Rupee upon dollar. So which is you take this rupee and take it on a numerator and divide by dollar, which is become a denominator, into dollar, which is again a numerator here, and divided by a denominator dollar. Okay. So you have to always adopt this formula. This side, the right hand side will become the numerator and the left hand side will become a denominator. So once you put this code, then dollar will cancel out. So we'll be left with rupee upon euro. So this will become €1 is equal to how many rupees? Okay. So €1 will become rupees 90.80. How we have arrived? By multiplying 83.30 into 1.09. Okay. So if this way, we will be able to find out the price of €1 in terms of rupees. So in many questions, students, what will happen that you won't be given the price of the currency. So you have to use the cross-currency mechanism for calculating the price of the currency. Okay. So we'll do some questions in our later part of our day. and we'll be using this technique. Now, but for applying this technique, one currency should be European, another should be American. Okay, fine. So if it is not in there, you can first convert them into European American codes, and then you can solve your question, or you can even apply a shortcut, which I'll talk about little later after another 2 slides. If the codes are not, I mean, both the codes are European or both are American, so how do we solve? Can we solve simply by without converting them into one European and one American? So look at this again, a code. $1 is equal to euro 0.88, and 1 yen is equal to $0.0093. So that means this is a direct quote. The first quote is a direct quote of which country? For example, Germany, or I mean France. So wherever the euro is there. So because on the right hand side we find euro. So if we want to buy $1 in Germany, it will cost you 0.88 at the time this price was there. Of course, the price keeps changing. Now 1 yen is given as in terms of US dollar is given. So this means this is a direct quote of in America for buying 1 yen. Okay, because on the right hand side we have dollar. So this will become a direct quote of dollar. Now, what we need to find is what is the price of 1 yen in terms of euro. So which country you belong to? Normally, which country would like to belong to when this quote has to be found out? So the answer would be that you would be a European, or you would be particularly coming from a country like Germany or France, where the euro is being actively traded. So you are a European or a person from Germany, and you want to buy 1 yen. Okay, and the two quotes are given to you. So what you can do is you can just simply apply this formula, because the one quote, the first quote is which? European. The second quote is American. So both the quotes are in order. So we can simply multiply them. So European divided by dollar into the dollar divided by yen. So the dollar cancels out. So we have 1 euro is equal to so many yen. Okay. So 1 yen will be equal to so many euros. That means 0.88 multiplied by 0.0093. Okay. So if we do that, because the first quote is American, the first quote is European, and the second is American. So the quotes are in order. We can simply multiply and then calculate our desired currency rate. Now let's look at this quote. Now here this quote will require some change, because both the quotes which are given to you are in European terms. So as I told you, for understanding cross currency, this thing, so we need to have one currency in American, another in European. So we want to know what is the price of £1 in terms of euro. Now, yeah.
Some students are answering on the chat box also separate.
Okay, so I'll just look at the chat box.
Chat box also, there is a separate link portal for now.
But I have not seen any questions so far. Okay,
sir, not it is from the not Zoom chat box. It is from the separate chat box that is for the portal.
अच्छा, वो कहाँ पर है? Where it is?
Sir, okay, sir. Actually, okay. I just tell you. So Mr. Manish Kumar has answered the same. Have you asked one question, na?
Yeah. Acha, he has answered.
So
okay.
It's a 0.008184.
Yeah, I'll just check.
Okay.
Okay, so fine, it's okay. Yeah, he's right.
Okay.
Yeah. Okay.
After the break, sir, you just open another chat box also.
Okay, I'll do that. Okay, I'll do that. So because I was not knowing that, so okay, fine. So if you look at this quote, now as I told you, if you look at the two quotes, they both are European quotes, and what we are required to find, the price of a pound in terms of euro. Now, normally that means which country would you belong to? You will belong to a country where the euro has been actively traded. That means you are either a German guy or a French person, and you want to buy £1. That means you are willing to travel to England, and you want to buy £1, or you want to buy pound, or you are going to import something from England and you want to know what is the price of £1. Or you're going to receive some money from England in terms of pound and you want to know how much euros you're going to get. So either an importer or an exporter, or you're traveling to England. So you'd like to know what is the price of £1. But since the price of the pound is not given to you, but there are two quotes which are given to you. $1 is equal to so many dollars and $1 is equal to so many pounds. So since you are a person from Europe, first you would like to buy a dollar, okay, which I gave an example earlier. So the dollar quote is in order. The first quote is $1 is equal to so many euros. But then you will go to England and convert your money into pound. So the second quote is basically for buying dollar, isn't it? It's not for buying pound. So you would like to convert that. So you converted that. So you have now a price of £1 in terms of dollar. So now both quotes are in order. So you can buy first a dollar in your country, like Germany or France, and then go to England and you buy a pound. So £1 is equal to so many dollars. So now the first quote is basically the European and the second quote is American. So the quotes are in order now, and you can just simply multiply them and get the result. So I'm not repeating all what I have said earlier. Okay, so since I have already explained how do we do it, so we have $1 is equal to so many euros, that is 1.114. I think it's clear. So I'll just look at the chat box if you have any questions. Okay, yes, Manish Kumar, you're right. I can see your answer. Okay, so yeah, 1 point. Now, this was 1.114. Yeah, Mr. Mankad, you're right, absolutely. Now, there's another way through which you can calculate. Here we are multiplying. Now, since we can use both the quotes, look at the first box. Okay, here you just focus on the first box. Both the quotes are in European terms. Okay, and you don't want to convert them into one into American, another into European. So you can just simply do is you can divide 0.88 by 0.79. So you will get the same answer, 1.114. Instead of multiplication, you have to divide. Okay, but always remember the first quote should be a home currency quote. $1 is equal to euro 0.88. Okay. If it is not given in home currency, first convert that into home currency, then you can just use a division formula for doing it. Okay, fine. So this is how do we convert into the currency. Now, the second most important concept is called the bid, offer, and spread. Yeah. Mr. Mankad, I hope you have understood, or Mr. Munish Gupta, the cross currency. If you have any questions, you can just raise them on the chat. Okay. So we have bid, offer, and spread. Okay. So this is another very, very important concept. So let's talk about that. So a foreign currency quote are two-way quotes expressed as bid and ask rates. So whenever we go to a dealer and if you want to buy any currency, so we will get the quotes. So let me just put my I'm just getting a power signal that I'm losing some power from my computer, so I'm just going to put this thing. Okay. Yes. So sorry for that interruption. The foreign exchange quotes are two-way quotes expressed as bid and ask rates. So whenever we go to an agent or a bank and we want to buy a dollar or a euro or a yen or a pound or any currency, but now I'll talk about dollar only. When I say dollar, it means any currency. So instead of mentioning all the currencies, I'll use the word dollar, which represents all the currencies to make the life very simple. So whenever you want to buy a dollar, the bank will give you a two-way quote because he doesn't know that you have come to buy or you have come to sell. So it's a customary for a bank to give you a two-way quote. So the two-way quote will have a bid and a ask. So bid is the price at which the dealer or a bank is willing to buy another currency. So the first part of the quote will be bid, and the second quote will be part of the quote will be ask. It's a rate which the dealer is willing to sell another currency. So the first is if you have dollar with you, at what price he is going to buy from you, or if you want to buy a dollar, then you look at the ask rate because at that price you're going to buy. So normally, the bid belongs to the exporter and ask belongs to the importer. So if you're an exporter, you will always go to the bank to sell the dollar. If you are an importer, you will be always looking at the ask rate because you would like to buy a dollar. So this is the way to understand it. For example, the dealer may quote Indian rupee as rupees 83.30 and 83.40 vis-a-vis dollar. So this is the quote which he has given to you. Which what does it mean? That means that he is willing to buy the dollar at 83.30, okay, per dollar. Fine. So this is the price at which he is willing to buy from you. Okay. So that means he's going to sell rupees and buy dollars from you. Okay. The second is while he will sell dollar at 83.40. So if you have to buy, he's going to charge you 83.4. This is the price for which he's going to sell to you. So he is going to sell the dollar to you. So that means he's going to buy rupees from you and sell dollar to you. Okay. So the difference between the bid and ask is called the spread. Okay. So look at this quote 183.80. Again, I'm revising it. So 83.30 is a bid price and 83.40 is ask price. So 83.830 is the price at which you will like to sell your dollars as a customer. And as a customer, when you want to buy a dollar, you will be charged 83.40. So when you buy it, it becomes costly for you. When you sell the same dollar, you get a less price. Okay. So the ask is always higher than the bid as interbank dealers make money by buying at bid and selling at ask. I hope this concept is clear. And uh, okay. So I just understood that Mr. Mankat is not very clear about the cross currency. Okay. So I'm just going for his understanding and just going back to you. So, look at this, quote again. Okay. So, first box is basically you want to, know the price of £1 in terms of euro. Okay. Let's, hide others. So you want to know what is the price of £1 in terms of euro. Okay. Fine. Now look at what does it mean that you are a person in Germany or a France where the euro is prevalent and you want to buy a pound. Assume very simple state that you are going to travel to England. So if you're traveling to England, you need pound. You can't have euros in your pocket and you can shop in England. So you need pounds. So first you're going to convert your euros into pound. Okay, then you can be there in England and buy anything from there. So first, what you're going to do is that you're going to buy a dollar. Okay. First, you're going to buy a dollar. So first quote is $1 is equal to so many euros. Okay. So you like to know that what is the price of euro or what is the price of a dollar in terms of euros. So you're going to buy a dollar. Then you go to England and convert your dollars. Now you have dollars with you, okay, because you have converted your euros into dollars by using the first currency. So you have now euros. Now you have dollars with you. So you have reached England. I'm talking about this is physically happening about 20, 30 years back. So when you go to England, you have what you have got dollars with you. So you need a pound quote, okay? But do you have a pound quote? No, because the quote is $1 is equal to so many pound. Okay, so you would like to first convert them. So £1 will be equal to so many dollars. Now you can surrender your dollars and buy £1, okay, or as many as pound you want. Okay, so if these quotes are given, so that means the first quote is European, the second quote is American. So it's a perfect quote. We can just simply multiply them and calculate. So here we just multiply them. So dollar cancels out and euro upon pound remains. So remember that the right hand side currency will go to the numerator and the left hand side currency will go to the denominator. Okay, so do that and then cancel out the common term, which is the dollar here. So we'll have euro divided by pound. Okay, so now you can just spread that. So we'll have one pound will be equivalent to so many euros and you multiply. Now, since you don't want to do this, first convert the currency into the second box I'm talking about, this box. Okay, this box. So you don't want this step. So what you can do is you can just simply do a division. So take 0.88 and divide by the second currency code, which is 0.79. So you will get the same answer. Okay, fine. But you should be always worried about, or you should first make a change is quote, the first quote should be the quote of your direct quote of your home country. Okay. For example, the direct quote of the home country is $1 is equal to so many euros because you are a European guy, okay, and you want to, buy pound. So the first, quote should be your home currency code. Okay, then only you can do this division. So if you're not followed, then follow the first method, which is always a foolproof. Okay, fine. The second, if you become a little bit more, trained and you can calculate by doing the second mechanism. And most of the questions you have answered in your study material are using the second method, which is you only learn by experience. Okay, fine, Mr. Vankat. Okay, so we are going to talk about that. So this we have done. So now we come to rules. I'll just look at the chat box, Mr. Vankat. Yes. Okay, so Vankat, so you can just go through this and you will be able to understand. Now we go to the rules. Okay. Now we know that the bid price indirect is equal to 1 upon ask direct. Or similarly, the ask price indirect is equal to 1 divided by bid price direct. Suppose you want to convert a direct quote into an indirect quote. So this is the mechanism, this is the formula which we use. So a full quote is given to you. It is given in direct. You want to convert into indirect, then do this. And why do we do that? We will soon understand that because it helps you to solve many questions in your exams or also to understand the whole gamut of foreign exchange calculations. Now, suppose this quote is given. $1 is equal to rupees 80.81. That means bid 80 is the bid and 81 is the ask. Okay. If you want to buy a dollar, you have to pay 81. If you want to sell a dollar, you will get 80 bucks. So from dealer perspective, a dealer will buy dollar from you at 80 and sell dollar to you at 81. Okay. So this is a direct quote for a dollar in India. I told you. So this is a direct quote because on the right hand side, look at the quote. So the currency which is appearing on the right hand side will tell you this is the direct quote of that country. Okay. So direct quote of for US in India is 1. Now convert this into an indirect quote. So how you will do? So you take bid is equal to rupees 1. It will be equal to 1 divided by 81. Okay. And ask will be rupee 1 divided by 80. So you just, jumble the things and you will get the answer. So because we know that bid price indirect is equal to 1 upon ask direct. Okay. Similarly, here also we have, okay. So this we can do it. And then you can, write. Now we know that bid price for trader is always lower than the ask price. So we know this, that the bid price is for the trader is always lower than the ask price. Okay. So bid is basically the price at which he's going to, receive currency from you. Okay. Bid price for the trader is always lower than the ask price. So ask price at which the dealer would like to buy, sell the dollar to you, and bid at which he's going to buy from you. So bid is always lower than the ask price. We know that. Okay. So when we solve this, we'll get this. Okay. So look at this also. The bid price is lower than the ask price. So even after calculating the indirect quote, we get a result where the bid price is lower than the ask price. Okay. So let's just go back and again revise that. So we know that 1 rupee is equal to 80-81. So 80 is the bid, 81 is the ask. So we are converting a direct quote into an indirect quote. So that means 1 rupee is equal to $1 divided by 81, and ask will be 1 rupee is equal to 1 divided by 80. So we always know that even after doing this, so we'll have the bid will be lower and the ask will be higher. So that means if you want to buy 1 rupee as a customer, you have to pay a higher dollar price. But if you have 1 rupee and you want to convert that into dollar, you will get less dollars. Okay. So as a customer, so that, a kind of a parity is maintained even after doing this calculations. Okay. So now we come to the interbank rates. So let me see if you have any questions. Mr. Vankat, you said, okay, good. Now let's understand interbank rates. Interbank exchange rates are wholesale rates. Now we know, there are two kinds of rates. Whenever we go to a bank, or whenever we look at the currency rates, there one is called the interbank rates. They are the wholesale rates. Normally, when we buy a currency as a customer, we don't buy the currency at an interbank rate. We buy at a merchant rates. Okay, so they are the wholesale rates. These are the rates which are prevalent between the rates among banks themselves, which are applicable for transactions among banks. So interbank is a wholesale rate. So that rate which one bank is dealing with another bank, either they are willing to buy or willing to sell from each other. So that is the rate which is quoted among themselves is called the interbank rate. The forward rate that is available in the interbank market cannot be applied as such for customer transactions. Okay, so the forward rate that is available in the interbank market cannot be applied as such to the customer transaction. So these are the rates which are actually given for the bank themselves. So the rates which are quoted, which you see on a screen, are for the rates which it is applicable to bank themselves. Okay, so let's understand again, and then we'll try to convert the interbank rate into the merchant rates, which is basically helpful for all of us. When we go and buy currency, we buy at the merchant rates and not at the interbank rates as a customer or as a corporate guy. But if you are a bank, then the interbank rates are relevant for you. So the Forex interbank market is wholesale currency arena. So interbank market is basically a wholesale currency arena. The interbank market is a global network utilized by financial institutions to trade currencies between themselves. Most interbank trading is proprietary, meaning that it takes place on behalf of the bank's own account, and also it is done by banks on behalf of large customers. So interbanks are basically the transactions which are happening among the bank themselves, and all the transactions which are happening are proprietary in nature. Okay. Now, let's understand that. How do we convert interbank rate into a merchant bank rate? If the spot rate for dollar is say 83, okay. Suppose let's look at one rate. Let's not complicate by looking at bid and ask rate. Let's say the spot rate for the dollar is 83. If the forward margin for 2 months is 10 paisa, okay, that means the dollar is trading at 10 paisa premium over the spot rate. So what will be the forward rate? 83 rupees 10 paisa per dollar. So this is a revisionary class, and you understand how to calculate a forward rate. There's a simple example of doing it. 83, and we'll add. So this is a spot rate. If we add a forward margin for 2 months, we will arrive at a forward rate, which is 83 rupees 10 paisa. Now, thus, if a bank wishes to keep a margin of 3 paisa, it will quote a rate of 83.13 for a customer, for an importer. Now, suppose you are an importer. You went to the bank. Now, you ask the bank that I want to buy dollars after 2 months. First, what is going to check? He's going to check what is the interbank rate. Okay. So he arrived the interbank rate at 83.10, 83.10. Now, that means he can buy the dollar at 83.10 from another bank, which is an interbank rate, but he would like to sell you at a profit. So, he'll keep a margin of 3 paisa. So he'll give you a quote of 83.13. So that means if you place an order with the bank as an importer for buying a dollar, so bank will give you a quote of 83.13. He will buy the dollar from another bank at 83.10. So that means he's going to earn a 3 paisa commission with that. So this is the profit of the bank. How do the bank make profits? But if you happen to be an exporter, then they're going to take dollar from you, or you're going to deliver a dollar to the bank at 83.07. Okay. So bank will say that we will pay you 83.07. And they will, sell these dollars in the interbank market at 83.10, making a profit of 3 paisa. So to the ask rate, we add the margin. To the bid rate, we minus the margin. So this is very important concept, and please try to understand it carefully. Whenever the quotes are given, the interbank quotes ask quote is given, we need to add the margin. Whenever the interbank quotes for bid is given, we have to minus the margin to arrive at the merchant rates. So we'll do some questions so that you can understand it more clearly. Now, before we dwell into our important questions on the similar lines, we'll talk about some concept here. Exchange rate applicable among transactions between the two banks, forex dealer is known as interbank market. So this is, we know that the transactions which are happening among the bank themselves is called the interbank rate. Normally, the interbank rates are quoted up to 4 digits after the decimal. Rates are rounded off to the 4 decimal in multiples of 0.0025.
Actually, I think there is one question from Mankarji
Acha.
just in the chat box.
Okay, in my chat box.
This is a portal on the portal.
Acha, because I'm not able to see that. So, Mankad, does the bank share interbank rate? This is the question. What are you talking to, Ashok?
Yeah.
Okay, okay. So, does the bank share interbank rates? Interbank rates, you can always look at the interbank rates at the normal sites which are available. Okay. And normally when you go to the bank, they will always, give you the merchant rates. Okay. Because the rates, you can always look at, these rates are openly available in the public domain. Okay. The rates can differ from site to site. Okay. But normally it will have a very little difference. Okay. So the bank will always give you the merchant rates because you are more interested to know the merchant rates rather than the interbank rate. But I mean, big customers like who deal in millions and billions of dollars, like companies like Reliance and other companies, they have mechanism to understand the interbank rates, and they can get the interbank rates from the banks. Okay, because they are dealing with huge amount of transactions. Okay, but normal customers, they won't be worried about knowing the interbank rates. So you can have, for a reference, you can go to the interbank sites and look at the rates which are prevailing at that time, which is giving you equally a good amount of feel about what the rates, which are prevailing in the interbank market. Okay. So we're talking about exchange rate applicable for transaction between two banks is known as interbank rates, and interbank rates can always be known by looking at various sites. If you go to my and listen to my video in my full lectures, I have given the links, and I have shared you the interbank rates how you can find. But otherwise, if you search on Google, you will find the interbank rates. Okay, fine. So normally the interbank quotes our rates are quoted up to 4 digit after decimal. So rate for rounded off to 4 decimal multiples will be in the tune of 0.0025. Okay. So let's do before doing question. So let's look at this. So interbank rates, we know that there is a bid and ask rate. So the rate for exporter is the bid normally, to remember that, and rate ask rate is normally for an importer. Whenever you want to buy a currency, you look at the ask rate. Whenever you want to sell the currency, so normally will be an exporter if you are going to sell the currency because you have got dollars, euros, you want to surrender to the bank and convert them into your home currency. But in case of a ask rate, you would be normally an importer because you would like to import goods from outside. You would like to know at what price you can buy the currency from the bank, or you are traveling abroad. Okay. Or there can be any transaction for which you need a foreign currency. You will be looking at ask rate. Now, deduct margin from the buying rate, as I explained this concept earlier. Add margin to the selling rate. After you do that, you will add the merchant bid rate and the merchant ask rate. Okay, so this is how we calculate the convert the interbank rates into the merchant bid rate. So when you approach to the bank will always give you the rate, the desired rate, the desired merchant bid rate, and the desired merchant ask rate. The quotes will be given in merchant rates. Now, let's look at how do we solve it. So quotation for US dollar in interbank market is as follows. So look at this question carefully, and quotation for US dollar in the interbank market is as follows. Spot rate is 83.29 and oblique 2975. So 83.2900 is the bid rate, and 83 83.2975 is the ask rate. Exchange margin is 0.10. So that means the spot rate is this is the interbank rate. The exchange margin is 0.10. Determine the spot merchant rates from the above information. The rates are rounded to 4 decimal in multiples of 0.0025, so which we have already learned. So this is the FEDI rule. So what we'll do, so just put these rates here. One US dollar is 83.29 and ask is 83.2975. So this is the quote which is given to you. Then we look at the margin. Margin is 0.10%. Deduct the margin from the bid and add the margin to the bid ask. So if you just do the calculation, 83.29 into 0.10% and press minus, and you will have, before you press the minus, you will have 0.08329, the margin for bid, and for ask, you will have 0.083297. Okay. Once you have write these points, then margin, then you just simply add the margin to the bid, deduct the margin from the bid and add the margin to the ask, you will have the merchant rate. So 83.3729 is the merchant rate for bid and 83.2142 is the ask rate for merchant. Now, these quotes are not up to the decimal places, so you convert them into a round off to the 4 decimal places. So 83.3729 will become 83.3750. So the nearest multiple of 0.0025 would be 50. Okay, fine. And here it will be 0.2142 will become 50. Fine. Is that okay? I think this needs a change. This will become, so a small mistake which I've committed. So this should be actually rounded off to this. Okay. So the nearest multiple would be 0.25. Fine. Now it's in order. Okay. So 42 will become 50 and 29 will become 3725. Okay. Fine. So I hope you got it. So is there any questions? Let me just check. Okay. Fine. So at the moment, I can see the chat line. I'm not able to see the Zoom one. So bear with me for some time. Maybe after the break, I'll go to the Zoom also. Okay. So now let's understand the exchange rate determination. Okay. So let's understand how the exchange rates are determined. Now, there are various theories of exchange rate determination. The first theory is called the mint parity theory, which is the oldest theory in the world, where the price was fixed on the price of the gold. Of course, now this theory has gone long ago, but from the historical perspective, we must understand that. So gold price in Britain was one, say, for example, the gold price in Britain was £20 per ounce. And in US, it was $80 per ounce. So that means $1 will equal to £1 will equal to $4. Okay, so this was how the price of the price of the two currencies was fixed. It was based on the gold price in the relevant countries. Now, if the gold price in Britain was £20 per ounce, and suppose in America it was $80 per ounce, then which will translate the price of £1 will equal to $4. Now, this theory is over now, so let's not worry about it. The second is called the purchasing power parity theory. Now, if the price of the computer is $500 US dollars in New York, and the same computer cost 2,500 Hong Kong dollars in Hong Kong. So it will give you, as per the parity theory, it will give you that $1 is equal to 5 Hong Kong dollars. So this is called the inflation rate differential. Okay. Now, the third theory is called international Fisher effect theory, which is based on the nominal interest rates, future risk-free nominal interest rates. Now, The last theory, which is called the interstate parity theory, which is almost similar to the Fisher effect theory, which says that there is a strong relationship between interstates movement in one in of the currency values. So that means, for example, if US interstate is 2% and India the interstate is 6%, we talk about when we talk about the interstate, we talk about generally we talk about the 10-year yield, okay, or even a short-term yield, 1 year, 2 year yield also. So the yield in US Treasury yields are, if currently trading at 2%, of course nowadays they're hovering around 4%. But historically, they have been always, trading at around 2%. Okay. And India, suppose if they're trading at 6%. Okay. So if the spot rate is 83, then 1 year forward rate would be 83 multiplied by 1.04. That means the interest rate differential between the two countries. Suppose the interest rate is 6% and US it is 2%. So the difference between the two countries' interest rate is about 4%. Now, this is largely due to the inflation in India is higher and US it is lower. So normally interest rate in India will be higher compared to US. So the difference according to the two interest rates is 4%. So that means if the dollar is today trading at 83 rupees, then the dollar after 1 year would be trading at 4% higher. Okay. So it will be 86.32 per dollar. Okay, so this is how we calculate the forward rate when we use the interest parity theory. Okay, so according to the interest parity theory, the forward rates are dependent on the prevailing interest rate in the two currencies. Fine. So forward rate can be calculated by the formula which is called F divided by S, where F is the forward rate and S is the spot rate, is equal to 1 plus R H. R stands for the interest rate in home currency and RF stands for the interest rate in the foreign currency. Okay. So where F and S are future and spot currency rates, RH and RF are simple interest rate in the home currency and foreign currency. Look at the on the top this thing. So we can rearrange the formula. So the forward rate will be equal to the spot multiplied by 1 plus I, which is the interest rate in the home currency, divided by 1 plus I interest rate of the foreign currency and raised to power n. Suppose you want to calculate the rate for 1 year, then the n will be 1. If you want to know the rate for 2 years, then n will become 2. So if you want to know what will be the forward rate between the dollar versus rupee after 2 years, so we should know the spot rate and the interest rate in both the countries. Okay, so we can arrive at the forward rate for 2 years or 3 years like this. We can always know that. Okay, so let's look at the question. Before we look at the question, let me see if there is any any question. Okay. Suppose if the present interest rate for 6 months borrowing in India is 6%. Suppose the present interest rate for 6 months borrowing in India is 6% per annum and the corresponding rate in US is 3% per annum. And the US dollar is selling at in India at 83.25. Okay. Will US dollar will be premium or at a discount in the Indian forward market? So this is the question. So those who are there now, joined the and listening to my video. So please answer the first question. The present interest rate for 6 months borrowing in India is 6%, and the corresponding rate in USA is 3%, and the US dollar is selling in India at 83.25. Will US dollar will be at premium or discount in the Indian forward market? So please answer these questions before we move any further. I'll just wait for your replies. So do it on the chat line rather than on the Zoom so that I can see you. Okay, so Ashok is for month rate. So I'm asking a question that will US dollar will be premium or discount? So your answer should be premium or discount. So mention premium or discount. So because if the rate of interest in suppose in India is 6% and in America it's 3%, and premium. So absolutely right. So Abresh, you are absolutely right. That will be trading at a premium. Good. Find out the expected 6 months forward rate for the US dollar in India. So using the formula which I just explained, calculate what will be the rate for 6 months forward rate. Okay, do that. Use this formula, the formula which is written at the top. Okay, the form you can see this formula which is I mentioned F is equal to S, which is spot rate, 1 plus I interest rate in home currency, 1 plus I interest rate in the abroad currency. So use this rate. Okay. Find out the expected 6 months forward rate for US dollar. So please do that. Can you? So I'll just wait for a couple of, yeah, you're saying premium, it's fine. Find out the expected 6 months forward rate. Now, these rates are, just to give you some clue, the rates are 6% per annum and 3% per annum. And you have to find a 6 months rate. Okay. So find out the rate of forward premium or discount. So this is what you are required. So I'm just now going through the further part of the answer. So under the given circumstance, USD is expected to be quoting at a premium in India as interest rates are higher in India. So Mr. Mankad, you have replied it correctly. Absolutely. So the formula is this. Fine. So you need to do this formula. So which means that the 6% rate of interest which is given is for the whole year. So it will be 6 divided by 2. So it will become 3%. 3 divided by 2 it will be 1.5. So 1 plus, and then you just simply go and calculate. So just use this formula and tell me what will be the answer. What will be the forward rate after 1 year? After 6 months, sorry. Just calculate that and let me know what should be the rate. Those students who are watching. So So I'll just see by the time I think your answer, you might have answered will become 83.25 into 1.03 divided by 1.015. So it come to 84.48. I hope you have followed that. So now we have a forward rate. The spot rate is 83.25 and the forward rate is 84.48. After, looking at the interest rate of 6% in India and 3% in America, and for 6 months, the forward rate comes to 84.48. Okay. So now we want to know what is the rate of premium. So what we'll do, 84.48, which is the forward rate, minus the spot rate, which is 83.25, and we'll divide by the current spot rate, multiplied by 12, divided by 6 months, because it's we are we are trying to analyze the premium into 100. So that means the rate of premium is 2.96, close to about 3%. So just go back and see whether you have got the right answer. The rate of interest in India is 6%, in America it's 3%. So if you simply minus them, 6 minus 3, so the answer should be very close to 3%. The premium of dollar versus rupee. So you're getting the answer as 2.96. So it will not exactly be 3%. It will be lesser than 3%.
Ramesh
So,
sir, I think Mr. Mankad has given the answer. Premium, etc., has been made.
okay, so I'll just check that. No, I can't see the answer. I think he has written on the Zoom this thing, isn't it? I'll just see. So, but I can't see the answers here at the moment. So maybe
Okay.
So we'll do that during the break. Okay, fine. So that
Okay, okay,
so I can't see the answers because I don't know how to look at that chat as I'm trying to.
okay, okay, okay. No.
Okay, fine. Okay, fine. So so Mr. Bankar, you can just put your answer on the chat line, which you have been doing earlier, so that I can see your answer. Maybe after the break, I'll understand how we do it. Okay. So now, for example, let's move on to another example. The spot rate of US dollar is 83.1325. So this is the spot rate. That means if you want to buy $1, you can get a dollar at 83.1325. So this is a direct quote in India for buying US dollar. So 180 days forward rate for US dollar is given as 84.2525. Okay. So this is the first we find is a spot rate. Then the second box, we find that 180 days forward rate is given. Okay. Annualized interest rate for 6 months. Annualized interest rate for 6 months is 6%. Okay. And annualized interest rate for 6 months is 2%. Okay. Is there any arbitrage of possibility? If yes, how an arbitrager can take an advantage of this situation? If he is willing to borrow rupees 50,000, 50 lakh rupees, or he can even borrow $60,145. Now, this is a question which says that if the dollar is trading today at 83.1325, and after 180 days, the dollar is trading at 84.2525. Okay. Now, the interest rate in India is 6% and interest rate in America is 2%. Now, if we know that the dollar would be trading at a premium of close to about 4% compared to the Indian currency, because the interest rate differential is 6 minus 2. This is a ballpark number, but we can really calculate. So it will be a little less than 4%, little less than 4%, but eventually, it will be somewhere around 4%. Now, if it doesn't happen, if the dollar is not trading at a premium close to about 4%, then there will be an arbitrage opportunity. Okay. That means the dollar has not appreciated to the extent of that interest rate differential in the forward market. So if that happens, then we say there is an opportunity of arbitrage. So for better understanding, please watch my earlier videos where we have explained the whole concept. Okay. So here I am understanding that you know that if there is a the interest, if the forward rates are not reach to the level of the interest rate differential on either side, there will be an arbitrage opportunity. So let's be on that backdrop, we'll answer that question. Suppose the spot rate is 83 and the forward rate is this. And so this is the same question which I've just put in different lines. So the forward premium will be how much? So 83.1325 minus 84.25. So we have just pick up the rates and try to find out what is the forward premium. So it gives you 2.694. Okay. Whereas the difference is how much? 4%. But I'm getting 2.69. So that means the dollar is not fully appreciated, or the rupee has not depreciated fully. Okay. It should have rupee should have depreciated to the extent of 4%, or the dollar should have appreciated to the extent of 4%, but it has not. So that means there is an arbitrage opportunity. So when the dollar has not fully appreciated, okay, then there is an arbitrage opportunity. Or it can be the other way around. If the dollar is over appreciated compared to the interest rate differential, there will be an arbitrage opportunity again in that scenario also. But here it has the dollar has not appreciated to the fullest extent. Since the interest rate differential is greater than the forward premium, there is a possibility of arbitrage flow into India. So if the dollar has not appreciated to the extent of the interest rate differential, which is 4%, in that scenario, there will be flow of money into India. Okay, fine. The advantage of this situation can be taken in the following manner. Fine. So arbitrager will actually, find this as a great opportunity to make money, and this is called a riskless trade. So he will be making a profit immediately. Okay. So what he'll do, he will borrow US dollar. So if this is a situation where the dollar has not appreciated to the extent what is reflected in the interest rate differential, then the money will come into India. So that means you can borrow US dollar from abroad and bring that money in India. So amount to be repaid after 6 months. If you have, so before you, I mean, you have borrowed $60,000, okay? Because in the question it is given that you can either borrow $60,000 or 50 lakh rupees. But in this case, you don't have to borrow 50 lakh rupees, you have to borrow US dollars because the interest rate has not appreciated, the dollar has not fully depreciated, okay, not fully appreciated to the extent of 4%, okay? So you will borrow dollars. Now, when you borrow dollars, you have to repay the money after, suppose you have borrowed for 6 months, so you will be repaying your dollars back. So you have to pay 2% rate of interest, which is the rate of interest prevailing in America. So for 6 months, after 6 months, you have to pay $60,746.4. So let's again understand you have bought the dollars. Why you have borrowed dollars? Because the dollar is not fully appreciated. So there is an arbitrage opportunity. So you borrow dollars, okay, and the rate of interest in America is 2%. So that means after 6 months, you have to pay $60,746.40. Okay, which is a simple formula: 60,145 into 1.02, that's a 2%. And for 6 months, the total amount which will be repayable will come to 60,746. Now, the second step is convert the US dollar. Now, since you have bought the dollars from abroad, so you have dollars with you, you are going to convert them into Indian rupees. Okay. So the current rate is 83.1325. So you borrowed 60,145. So you will have 50 lakh rupees with you immediately. Okay. Then you can earn interest on that. That means you're going to invest that money in India. Okay. 50 lakhs. And how much you're going to get? 3%. It's about 6%. Okay. So for 6 months, it will be 3%. So you will get 1,50,000. So that means the total amount which you will have in your kitty after 6 months, along with the interest, will be 51,50,000. Okay. You look at the interest rate in India, it was 6%. So when you say 6%, which means for 6 months, you can multiply it by 0.03, or you can simply multiply it by 1.03, and you will have 51,50,000. So this is the money which you have after 6 months. Now, at the time when you saw the forward rate was 84.25, when you look at the rate, the forward rate was 84.2525. So you booked a forward contract at the time when you borrowed the dollars. After 1 year, you're going to take your money out. So you immediately booked a forward contract at the time when you borrowed the money. So now you have 51,50,000. You will convert that money at the forward rate and take this money abroad. How much you are taking the money abroad? 61,125.80. Okay. Now you are sitting with a total amount of 61,125. But if you look at the second column, the third column here, you have to pay 60,746. So the difference is your profit. So the gain will be 61,125.80 minus 60,740 rather. Okay. So, which means that you will be sitting at a profit of $379.38. So if you convert this at the forward rate, assuming this is the rate which is there at the time when you want to convert and find out what profit you have made, you have made a profit of 31,964 by doing this arbitrage opportunity which was available to you. Okay. I hope you have followed. If you're not, I'm just going to repeat it once more. I know this is a little bit tricky. Okay. So, let me just again take you through the example slowly and gradually so that you understand. Okay. So this is what was given to you, that the current spot rate is 83.1325. 180 days forward rate is 84.2525. So we're finding the dollar is appreciating in 180 days to some percentage. Okay. The annualized interest rate is 6% in India and annualized interest rate in America is 2%. Now, the question is that is there any arbitrage possibility? If yes, what the arbitrager will do? Will he borrow 50 lakhs in India or will he borrow 60,000 US dollars? Okay. So since the answer would lie, which way, how much the dollar has appreciated. Okay. So here we found the dollar has appreciated in the forward market to the extent of 2.694%. Whereas the interest rate differential theory is suggesting you that it should have appreciated by 4%, close to about 4%, isn't it? So that means the dollar has not appreciated to the full extent. So which means if the dollar has not appreciated to its fullest extent, we will borrow dollars. But if the forward premium would have been more than 4%, say about 5% or 6%, in that case, we would have borrowed Indian rupees. Fine. So in this case, we need to borrow dollars. So what we'll do, we'll borrow dollars. We'll first borrow dollars, okay, and convert those dollars into rupee and invest that money in India. At the same time, we'll take a forward cover, okay, the rate is given to you today. So you take a forward cover to take the money back to your home country currency, which is the US dollars, and then find out what is the profit you have made. Okay. So here you borrowed dollars, okay, and you have to pay after 6 months, you have to pay 60,746. So this is the money I'm going to pay after 6 months if I buy dollars, borrow dollars today. Okay. Now, since you have borrowed dollars, how much? 60,145. So you're going to convert them at the spot rate, which is prevalent today. So you will get 50 lakh rupees in your kitty, in a bank account. Then you're going to put that money in a bank and that money will grow to 51 lakh 50,000. But since you have already taken a forward cover at the 6 months at the time when you borrowed the dollars, at the same time you have booked a forward contract. So now you're going to use that forward contract to convert your rupee, which is 51 lakh 50,000, and convert them back into dollars. Because after 6 months, you have to repay your dollar loan. But once you look at your dollars today, after 6 months, you will find the dollar has gone up to 61,125. But now you have to pay only 60,746 after 6 months. So how much profit you are making? You're making a profit by simply entering into this transaction, first borrowing the dollars and taking a forward contract, 1 year forward contract. By doing this simply 2 steps, you're making a profit of 379.38. So please understand this. You have to take 2 steps. First, borrow dollars. Second, take a forward cover at the same time, because you're going to convert that dollar into rupee, invest in India, and take that money abroad back and convert them into dollars and repay back your loan. So you will find that you have been actually made a profit of 379.38, which translate in terms of Indian rupees as close to about 31,964 rupees. Okay. So this is the question. The gain is to be calculated at forward rate or spot rate. Now, that's a very good question, Mr. Mankad. Now, since in this question, the spot rate after 6 months is not given. No, we can't use the spot rate which is given in the question because that spot rate is the current spot rate. Okay. But you are trying to find out how much money you have gained after 6 months. Okay. So, so if the spot rate after 6 months is given, use that rate to calculate your gain. Okay. But in the absence of any spot rate after 6 months, the forward rate is given. So you are trying to calculate, assuming that the forward rate is, almost near to the spot rate after 6 months, because the interest rate differential will, prevail over the time. So you will find that so you have used the forward rate to just to find out the how much profit you have made. But this is not right. You should use the spot rate after 6 months, because in this question the spot rate is not given. So just for the purpose of knowing how much money you're making, so I've just used the forward rate. Okay, fine. That's good that you have asked this question. This is a very intelligent question, and many people miss this point. And if you understand this, that means you're understanding the whole topic very well. Okay. So let's talk about, and now we'll, have a break. So it's about 8:22. So we'll have a 15-minute, 10 to 15 minutes of break and see you after 15 minutes. Okay. Fine.
One second.
Yeah, yeah.
Mr. Mankad, please, you first log out from the Zoom and then re-log in. Then, of course, we shall permit you, we shall allow you. So, this is a message for Mr. Mankad.
Okay.
Okay, Ashokji, when Mr. Mankad comes in, join the Zoom, please you allow him. Okay, okay, Mr. Mankad, in case if you could not join, please put your mobile number in the message box, so we will contact you. Thank you. Okay, Ashokji, please start the break.
Okay. exposures we have, while we are, exposed to the currency risk. So there are three kinds of exposures. One is called the translation exposure. Another one is called the operating exposure, which is also called the economic exposure. And the last is called the transaction exposure. So all are very relevant for us, basically. Okay. So these are the exposures which, foreign exposures, risk exposures, which we are exposed to when we are dealing in foreign currency. The first one is called the translation exposure. Now, translation exposure would be basically a company's equities, assets, and liabilities or income will change in value as a result of exchange rate changes. So normally this is used, this translation exposure is normally of a significance when we are making our consolidated balance sheet, when we are consolidating holding and a subsidiary company, where either a subsidiary holding company is a company which is having a foreign subsidiary company. Okay, so if you have one of the company is is of another currency, then when you consolidate, so you make a translation exposure. So you have a translation exposure. So operating exposure and a transaction exposure. Let's understand one by one. It is a risk that the currency exchange rates will fluctuate after the firm has already undertaken a financial obligation. So you enter into various transactions. Either you import or export, or you travel abroad, you need foreign currency. So this is the risk that the currency exchange will fluctuate after the firm has already undertaken a financial obligation. For example, let's take if you are an exporter. If an Indian exporter has receivables to the tune of $1 lakh during 6 months, hence, if the dollar depreciates relative to the rupee, the cash loss occurs. Suppose the time when you exported the goods, the dollar was at a certain rate, and if the dollar has depreciated, say from 83 to it became 81 now, so you're going to lose money to $2 rupee per dollar. Okay, so cash loss occurs. Conversely, if the dollar appreciates relative to the rupee, the cash gain occurs. Now, at the time when you made the exports, the dollar was 83, but at the time when you're receiving the money, it's 85. So you're going to get $2 extra, 2 rupees per dollar extra. Okay, so the cash gain will occur. So either there can be a cash loss or there can be a cash gain. The cash gain will happen when the dollar appreciates if you're an exporter, and if the dollar depreciates, you're going to suffer a loss if you're an exporter, and if you're an importer, it'll be the vice versa. Now, let's take an example. For example, of a transaction risk. For example, a British company is repatriating profits to UK from its business in France. So a company, you are a British company, you are repatriating profits to UK from a business in France. So you have your business in France, and whatever money you're going to earn, you're going to transfer it back to your own company in Britain. It'll have to get euros earned into France converted into British pounds. So that means whatever euros which you're going to earn by doing a business in France, you're going to convert them into British pound to bring that money back into your own currency. The company agrees to enter into a spot rate transactions to achieve this. Okay, so normally what they're going to do, you at the time when you are bringing the money back home, you're going to use the spot transaction rate. Generally, there is a time lag between the actual exchange rate and the settlement. As such, if the British pound appreciates as compared to euro, this company will receive fewer pounds than what was agreed to. So if the British pound has appreciated, during the time, by the time when you're bringing your money, so you will have less number of, pounds. Okay. So let's understand this, example. Suppose the euro pound, which is GBP, which represents the pound, the spot rate was 0.8599, which means 1 pound is equal to so many euros. 1 euro can be exchanged for 0.8599 British pounds. And the amount to be sent back is 1 lakh euros. So this was the rate, the spot rate prevailing at the time when you check the screen, that 1 euro was equal to 0.8599 pound. And you have already earned a profit of 1 lakh euro from your company in France. So now you want to bring this money in England. The company would expect to receive 0.85,990. However, if the pound or GBP appreciates at the time of settlement, it will require more euros to compensate for 1 British pound. For example, let's say the rate becomes 80.8368. So which means here what has happened is that and the company will now receive 83,680 pounds. So here what has happened that 1 euro has now become 0.83 instead of 0.85. So that means the euro has depreciated, okay, and the pound has appreciated. So since the pound has appreciated, so you will get less now, pounds, 83,680. So there's a loss of 2,310 pound due to the transaction risk. I hope it's clear. So at the time when you thought of bringing your 1 lakh pound back, 1 lakh euro back to the home country, which is Britain, the rate was 0.8599. By the time you acted to bring the money, the rate has gone down to 0.8368. So that means the euro has depreciated. The euro has become now 1 euro has become 0.8368 from a level of 0.85. So that means euro has depreciated, and you're going to get 83,680 pounds instead of 85,990 pounds. So you incurred a loss of 2,310 pounds. And this loss, which you have incurred, is called the transaction risk. Now, the other risk is called the translation risk. Okay, let me just see your chat line if you have any questions there. Okay, I think I'll just, have the chat again ready. I think I've lost the connection there, so I'll bring the chat line. Just give me a second. I'll just resume my lecture. Yeah, I'm back on the chat line. Okay, so gain is to carry forward. Okay, so this we have done. Okay, fine. So now the other exposure is called the translation exposure. This is the risk that the organization will make exchange losses when accounting results of its foreign branches or subsidiaries are translated into home currency. Now, this is called a balance sheet exposure. So this risk of foreign currency is due to translating your assets and liabilities and consolidating the branches or subsidiaries into your main account. So translation exposure is called the accounting exposure. A typical example of translation exposure is treatment of foreign currency loans. Okay, when you take foreign currency loans, in dollars, if the dollar appreciates, you have to pay more, and which means that you are going to translate them at a higher loan value in your balance sheet at the time when you're making your balance sheet. So let's understand an example here to understand it more easily. For example, a German subsidiary of an American company purchased a building worth 1 lakh euros on October 1st, 2022. So this is a German subsidiary of an American company, okay, which has purchased a building worth 1 lakh euros, okay, on October 1st, 2022. On this date, the euro-dollar exchange rate was 1 euro is equal to dollar 1.15. So that the value of the building converted into dollars would be how much? $1,15,000. So the American in the balance sheet will show the value of the building at 1,15,000. Okay. Now what happens was the company decides to convert all its foreign holdings into dollars to present a consolidated balance sheet as on 31st December 2023. On that day, the exchange rate changes to 1 euro is equal to $1.08, which means the euro has depreciated from 1.15 to 1.0. So which means the value of the building will fall to, we will show the value of the building in the consolidated balance sheet at a price of 1,08,000 instead of 1,15,000. So this is the risk of translation. Fine. So now we come to the economic exposure. This refers to the effect of movement of exchange rate on the international competitiveness of a company. Okay. So this is called economic exposure or an operating exposure. Economic exposure is a term used to define the risk posed by a foreign exchange rate fluctuation with adverse effects on the company's financial stability. So let's take an example to understand that. An Indian company uses raw material, which is priced in US dollars, but exports its product mainly within European Union. So that means there is a company which is buying raw material from US dollars, from US and paying the money in US dollars. But most of the customers, or having mainly all the customers are in America, in Europe, which is accepting euros. So what will happen? A depreciation of the rupee against the dollar or an appreciation of a rupee against the European currencies will both erode the competitiveness of the company. If the two things happen simultaneously, it will erode the profitability of the company. How? The depreciation of the rupee against dollar will make raw material costlier. That means the dollar has appreciated against the rupee or the rupee has depreciated the dollar. So that means you are now paying more dollars for the rupee, what you have exported or what you have imported from outside. So that means your raw material become costlier when you're selling, and an appreciation of rupee against the European Union will reduce the revenue because the rupee has appreciated, whereas the European, the euro has, depreciated. So it will reduce the revenue which you are bringing from abroad. So both will have an adverse impact on the company, and company's bottom line will get affected. So the result which happens because of these two kind of a transition and affects the profit of the company and ultimately affects the value of the company, because the profits will go down, the earning price per share, EPS will go down, and company will be trading at a lower price in the market. The valuation, the market cap, all will go down, and the result is called economic exposure. I hope you have understood. Okay. So let me see if I have any query on the chat line. Just give me this thing. I don't have any question on the chat line. So fine. So let's move on to hedging currency risk. So this is the most important topic, and most of the questions which are there in your paper are coming from these topics. So far, what we have done are the basic concepts, and some questions we may come on the topics which we have already covered, but this is the most important one. So hedging currency risk is a way of company to minimize or eliminate the foreign exchange risk. So there are two types of techniques through which we can hedge the currency risk. First is called the internal techniques within the business itself. So that means you don't have to go to the third party, okay, to do anything. You don't have to do anything except you have to look internals, your own internal business transactions, okay, and that will help you to mitigate this risk. The second is called the external techniques, where you involve a third party, okay. So these are the two techniques, and you go to a bank, or you go to financial institutions, or you go to the stock exchange, and if you're using the help of on any of them, then you are actually using an external technique. But if you're looking within the company to trying to hedge your transactions by altering your own transactions, it is called internal techniques. So let's understand the first, the internal technique. The first internal technique, we'll do only the main ones, the leading and lagging. Leading means advancing a payment. That is making a payment before its due date. Now, when are you going to do that? If you're an importer, if you feel that the price of the dollar is going to appreciate, okay, or any other currency which you're feeling they're going to appreciate, so you have to make more payments. So you are going to, make the payment immediately at the current rates so that you can save that loss. Lagging involves postponing a payment. So the first is leading, the second is lagging. Postponing a payment, that is delaying the payment beyond its due date. So that means if you expect the dollar is going to soften up, the dollar rates is going to soften up, and the rupee is going to appreciate, and you are an importer, then you can always postpone the payment and wait for the time when the dollar, the price, the rupee appreciates, okay, or the dollar depreciates, and you pay less. Okay. So let's take an example. X Limited imports 1 lakh goods from abroad. The current rate is 83, payable after 6 months. So you have an import liability of 1 lakh. The current rate is 83, but you have to make the payment after 6 months. A expects the dollar to appreciate significantly in the next 6 months. So X, what will X will do? So X plans to pay the amount upfront. So by doing this, if he pays upfront, your customer is, your supplier is not going to make any fuss because he's getting the payment immediately, but you are actually, and you can always seek some discount from him, and it saves you from the losses arising from the foreign currency fluctuation. If the dollar is expected to significantly appreciate among the rupee, then you can do this technique. Now we come to the other one. Another example. For example, an Indian firm which is going to receive payments from its customers in UK may press for the prompt payment from the customer if it expects the pound rate to fall in future. For example, today the pound is close to about 105. This is the rate currently, 105 point something. Okay. Suppose you expect the pound to depreciate to $100 and you are an exporter. So if you get the payment in time, that is after a time, so you are going to convert all those pounds into rupees, so you'll get fewer rupees. Okay. So you will ask your customer to make the payment upfront. You can give him some kind of incentive for doing that, and you save, and you have to do a cost benefit analysis so that if you are still saving, the customer, you can just execute your plan and you will get your money at 105. Instead of 100, you expect that pound to depreciate. Okay, fine. So when this happens, we say that the Indian firm is leading its receivables. Okay. So I hope you have understood. So this is the first one. So let me see if you have any questions. No, I can't see any this thing. So now there's another, let's talk about another internal technique. Invoicing in domestic currency. Invoicing in a domestic currency, an exporter can shift transaction risk to his customer abroad. So I explained to you at the beginning that if you are invoicing in the domestic currency, for example, if you are an Indian, if you're going to raise a invoice in rupees and make the payment in rupees or receive the payment in rupees, then you are shifting your risk on the customer abroad. Let's take an example. X Limited invoices rupees 82,000 for their exports. At the time of export, the rate was 82. Payment receivable after 6 months. Okay. So you have invoiced the customer at rupees 82 for their exports. At the time of export, the dollar was it down. So $1 is rupees 80 after 6 months. Suppose if that happens, the dollar is now at 80 rupees after 6 months. But it's not going to impact you. If you have raised the invoice in dollars, you have got 80, but now you're going to receive 82,000, not 80,000. So you have shifted the risk on the importer. Now, importer has to pay 1,025 to its bankers as against 1,000. So it's not going to affect your health at all. How? Because he's going to give you 82,000 rupees. So the rate is now 80. So he's going to pay 1,000. So you have shifted the exposure to your customer, to the importer, rather than to yourself. So this is one method. But now we come to netting exposure. So exposure netting is a method of hedging currency risk by offsetting exposure in one currency with exposure in the same or another currency. Okay, so it is basically two ways. One is by offsetting the exposure in one currency with exposure in the same or another currency. Let's see both the examples. For example, X India Limited owes 1 lakh to its group company X USA Limited. So there's a company called X India Limited, which owes $1 lakh to its group company X USA for the goods supplied. And X USA Limited also owes 80,000 for the services provided to X Limited. So there can be a netting off, and the resultant $20,000 can be transacted. Now let's look at another example. X India Limited owes $1 lakh to its group company X UK Limited for the goods supplied, and X UK Limited also owes 78,000 pounds for the services provided to X India. Now, if suppose the dollar rate is equal to 0.678, then there need not be any transaction. They can be set it off against each other. So that means here the dollar is getting set it off against a liability of in terms of pounds of 78,000. So both will get set it off. So either you set off one currency with an exposure in the same or another currency. This is example of another currency. Now, I think the last one is called the price variation, which involves increasing the selling prices to counter the adverse effect of exchange rates. Now, if you expect the dollars to appreciate, or the currency in which you are going to export is going to appreciate, so what you are going to do? You're going to, for example, if the company expects the pound to strengthen against the currency of an overseas customer, it may raise the price, the contract price. Okay. If you think that you're going to get, the dollar is going to, the pound is going to strengthen, so you can always raise the price for the customer so that it will not affect you. So let's understand now. We go to the important one. It's possible. Okay, so I'm just getting a question. It's possible that USD appreciate and euro depreciate with respect to Indian currency. Yeah, it is definitely possible. It is definitely possible that the US dollar is appreciated against euro. It is possible that US dollar appreciate and euro depreciate with respect to INR. Yeah, Mr. Mankad, it is very well possible. But normally, if the US dollar appreciates against the rupee, normally the euro is also going to appreciate. Okay, but to that at the same extent, no, it can appreciate lesser than US dollar, or sometimes it can even depreciate. But most of the time it will go in tandem. That if the US dollar appreciates, the euro also appreciates against the Indian currency. But at times they can have a divergent trend also. Okay, it all depends upon the economics and the balance of trade and inflation rate differential between the two countries. Okay, fine. If there is higher inflation in America and lower inflation in Europe, or against the Indian this thing, so it can very well, we can see that kind of a trend. Okay, hedging foreign exchange risk. Simple FX, foreign exchange hedging involving currency forward contract, is the heart of foreign exchange risk management strategies for many businesses, and is built into their forex international platforms, payment platforms. So whenever company who's trading and who is entering into international trade, they will always have these exchange forward contract mechanism built into their platforms. Okay, so that they can always use that to go for forward contracts whenever they have any exposure. Currency forward contracts lock in the exchange rate of the future payments in foreign currency. So if you go and take a forward contract, okay, with a bank, then actually you're locking the rate of US dollar or any other currency compared to Indian rupee, and that you're going to pay a certain amount of money well in advance, rather than wait for the time and look at the fluctuations, and either you going to lose or you're going to basically gain. So normally a businessman would not like to be more interested in the gains or losses arising from the foreign currency fluctuations. So he'll have a peace of mind. So he'll like to book a forward contract. Okay, unless your business is such that you are very happy if the foreign currency fluctuates, like if the dollar appreciates again in rupees, a software company which is exporting outside will not go for a forex cover. But normally most of the companies will like to go for a forward cover and take a forward contract with the bank, because they want to make money from their own business rather than making any money or gains or losses, because you can't predict any gains and losses in the foreign exchange exposures. So what are types of external techniques? So let's understand. So there are two main types of external technique. One is called the money market hedging, another is called the derivative instruments. Okay. So either you can use the money market hedging or you can use any of the derivative instruments. Okay. Like derivative instruments are like, the forward contracts, futures, where you use the stock exchange market, or the swaps or options. Okay. So we'll understand them, and you'll find most of the questions coming from these two topics in your exams. Let's go deeper into them. Money market hedging. So let's understand what is a money market hedging. Money market hedging. So in the meantime, just check if you have any query. Okay, no. So I'll move further. Money market hedge is a technique of using borrowings and lending transactions in foreign currencies to preserve the value of home currency during the foreign currency transactions. Okay, fine. It becomes a key tool for exporters to lower their transaction risk while conducting transactions in foreign exchange. So it is one of the key tools through which you can lower your transaction risk. Okay, so we'll understand more deeply, and you'll understand it well when we actually do a question. Okay, an example. The technique of hedging, the risk depends whether a firm has to pay or receive the payment in foreign currency. So either you're an exporter or an importer, it will depend upon what kind of, what steps you have to take. Okay. It also protects the retail investors and small businesses from currency fluctuations by passing the forward contracts of future markets. So here, during the process of hedging currency risk. So that means you don't have to go and take a forward contract or a futures contract. You can just simply bypass these markets, and do it through money market hedging technique. It becomes less complicated process to hedge the transaction exposure for a large corporation. So it is a less complicated, okay, and you can do it without, bypassing the forward or futures market. So let's talk about two case scenarios. Okay, and I'm picking the rupee dollar case to explain the money market hedge. Now, you can be either an exporter or an importer. So let's talk about exporter. So you're going to use money market hedge technique and you are an exporter. And let's take rupee dollar case. So the first step would be, since you are an exporter, what will happen? The money will come to you. That means the dollar is going to come to India. Okay. So what you have to do is you have to borrow dollars. That is a foreign currency. The first step would be to borrow dollars and bring those dollars in India. Okay. Immediately, without waiting, for the credit period that you are going to get money after 6 months or 3 months or whatever. So you borrow the dollars immediately, convert those dollars into rupee at the spot rates. Okay. The second step. The third step would be invest the rupee so the amount grows. So what the dollars which you have borrowed in the foreign currency, you are going to borrow in dollars. That means the foreign currency, because the dollar is a foreign currency, because you are looking at a rupee dollar case. So dollar would be the foreign currency for you. Okay. Convert the dollar into rupee at the spot rates and invest the money, the rupee, the amount, so that it grows. Now, since you have borrowed in the foreign currency, so pay loan with interest using receivables, which means you have borrowed dollars, you are an exporter, you're going to get your dollars after certain time from your customer. So you can pay off your loan by using your receivables. Okay, so this is the step what you're going to do in case you're doing a money market hedge. Fine. So the money which you have invested in, it has grown, and at the time you will get, after that period, you will be receiving the rupee. So that will be your inflow from the export transaction. Okay. So now, in case if you are a importer, so what you have to do is basically, if you are an importer, that means the money is going out of your country. That means you are going to send dollars. You are going to buy dollars. Fine. So you have to pay out the money. So you first borrow in rupees. Okay. Here you're going to borrow, convert rupee into dollars at the spot rate, and invest the dollars so the amount grows to pay off the US liability. So what you're doing it, you're preempting. You're just You're an importer, you have to pay the money abroad. You borrow money immediately, convert the rupee into dollar at the spot rate, and take the dollars into and invest those dollars, so that when you invest, you will get some interest, and that money will be sufficient to pay your US liability. Now, the loan which you have taken in the home currency plus the interest will become your cost of imports. Right? So this is what you do in case of money market hedge. So this is the case of a rupee dollar. It can be any case. You can apply the same mechanism to solve the question. So let's understand some questions of those sorts today. So practice questions. So let's do this question. So let's look at this question. An exporter is UK based company. Invoice amount is $350,000. So you're an exporter, you are a UK based company, and you have invoiced an amount of 350,000. That means you're going to get $350,000. Okay. Credit period is 3 months. That means you're going to get your money after 3 months. How much? $350,000. So this is the question. The spot rate is given, which is dollar versus pound equal to 1.5865. Bid and ask rates are given. 3 months forward rate are also given. So this rate is $1. 1 pound is equal to so many dollars. So 1 pound is equal to 1.5865. Okay, fine. Rates of the money rate of interest in a money market is also given. The deposit rate, the loan rates for both dollars and pounds are given to you, and compute and show how a money market hedge can be put in place. Compare and contrast the outcome with a forward contract. So basically, the forward rate is also given. The forward rate is also given. The interest rate differentials are also given. Okay, the deposit rate and the loan rate is given. So we'll use both the techniques and find out which is the technique which was giving you the maximum advantage. And we are going to follow that technique. Okay. So first is we are going to talk about the money market hedge. So since you are an exporter, okay, so an exporter, what he does is the foreign currency is receivable is 350,000. So you're going to receive 350,000. So what are you going to do? You're going to borrow dollars. As an exporter, you're going to bring the dollars home. Okay, you're going to bring the dollars. So that means the borrowing rate is 9% per annum. So you're going to borrow the dollars because the dollars are going to come to your country, which is England. So you're going to borrow it immediately. Borrowing rate is 9% per annum. So you're going to get the money after how many days? So let's talk about 3 months. Okay. So that means for the interest rate will be 2.25% per quarter. So amount to be borrowed would be 350,000 divided by 1.0225. That means how much money you have to borrow? 3,42,298.29. So if you borrow this amount, so that means it will become 3,50,000, and you're going to receive 3,50,000. So it will help you to meet out this liability. Okay, so you borrow to an extent so that when you invest the money, when the money is borrowed, that you have to repay it. So it will be equivalent to the interest on the borrowing, which is 2.25%. Will make it to 3,50,000. So that when you receive the money, it simply pays off your liability. Now, since you have borrowed that money, you're going to, since you have dollars with you, you're going to sell dollars and buy pounds. The relevant rate is ask rate, namely 1.5905. So if you look at the the question, then it is written that the rate is, if you just go back to the question and see, so 1.5865 and 1.5905. Okay. So you're going to look at the ask rate. sell dollars and buy pound. Note, this is an indirect quote. So amount of pound received on conversion would be 2,15,000, which will be 3,42,000, which you borrowed, and you are going to convert them into pounds. So you're going to get how much? 2,15,214.27. So you're going to use the ask rate. Normally, the ask rate is for importer and bid is for the exporter. But here you are bringing the money home, but the quote is indirect. That's why you're using the bid rate, because it is 1 divided by this, which becomes the ask rate. 1 divided by ask, it will become the bid rate. Okay, fine. So invest this 2,15,214.27 will be invested at the rate of 5%, because we know the investment rate in England is at 5%. For 3 months, if you invest, you will get 2,17,904.45. So first, you borrowed the money in dollars, converted those dollars into pounds, okay, because this quote is indirect. So we use the ask rate. So 1 divided by ask will become the bid rate. So you're using actually in fact, the bid rate. So 3,42,000 divided by 1.59. So that means this will convert your money into pounds. So it will be 2,15,214.27. Now what the second step would be, you're going to put this money into a deposit, and for 3 months. So after 3 months, your 2,15,000 pounds will grow to 2,17,904. Okay. So which means, if you look at the last column, ignore the fourth column, the liability of 3,42,000 at interest of 2.25% matures at 3,50,000 receivable from customer. So that means you borrowed 3,42,298 dollars. So after 3 months, it will grow to, you have to pay 3,50,000. You're going to receive 3,50,000 from your customers. So it will settle your liability, and eventually you have got 2,17,904 rupees, £4, sorry. Again, I'll repeat my mistake. You're going to get 2,17,904.45 pounds after 3 months, because you have invested an amount. And if you divide by 3,50,000, it will give you the exchange rate, 0.62. That means you're getting, at an exchange rate of 0.622584. Fine. Anyway, that's academic in nature. So we'll just go to using the forward rate. If we use the forward rate, the amount becomes to 2,16,000. Okay. So the forward rate is given to you, and you're going to, because since it is an indirect rate, okay, so we are going to divide that, and so you get 2,16,000. So amount received through money market hedge was 2,17,904. Using the forward rate, it was 2,17,000, and the forward rate was 2,16,000. So which one is better? The money market. So gain is how much? 1,051.1. So the money market hedge is beneficial for the exporter. Okay. So just look at this using the forward rate. So since the forward rate, which is given as 1.16, this thing, so we are going to use this rate. Okay. 1 point ask rate. So when we do the 1 divided by 1.6 become the bid rate. So actually you're going to receive the money. So you're going to sell your amount receivable with 3 lakh. So you go to the bank, and bank is going to give you 2,16,000 using this rate, 1 divided by 1.61 will become bid rate. So he's going to give you 2,16,000. Okay. So which will give you an exchange rate of 0.6158. So this is compared to with the money market rate, which was 0.62. So this was better. Okay. $1 is equal to this thing. So the money market rate hedge is beneficial for you. And if you even look at the difference between the money which you're getting to the forward market is 2,17,904 pounds, as against you're getting 2,17,904 in a money market technique, rather than the forward exchange rate, you're getting 2,16,000. So you're getting 1,051 more in a money market hedge. So use that. Okay. So the money market hedge is beneficial for the exporter. I hope you have understood. So let's now talk about another question. Just give me a while, I'll have water and then we will begin with the. So A Limited of UK has imported some chemicals worth US dollar 3,64,897 dollars. So A Limited of UK has imported some chemicals which are worth these dollars 3,64,000 from one of the US suppliers. So you are a UK importer, okay, importing chemicals from abroad, from US. The amount payable in 6 months' time. The relevant spot rate and forward rates are given to you. So this is the spot rate and this is the 6 months forward rate. The borrowing rate in UK and US are 7% and 6% respectively, and deposit rates are 5.5% and 4.5% respectively. The company has two choices: take a forward cover, go for a money market cover. Which of the alternative is preferable by the company? So let's see the question again. So you are an importer. You are going to, make a payment of 3,64,897 when after 6 months. Okay. The relevant spot rates are also given. The spot rate are USD 1.56. So that means £1 is going to be equal to this thing. But you need actually the dollar quote because you have to make a payment in dollars. So the quotes are given in indirect manner. So you have to convert them into that quotes. The borrowing rates are also given. Okay. The company has two choices: forward cover and money market. Which of the alternatives is preferred to the company? So let's solve it. Forward cover. First, simply the example, simple example. Simplest one, the forward cover. The amount payable in 6 month time is 3,64,897. Now, 6 months forward rates are given to you, which is £1 is equal to 1.5455 and 1.5609. So the first is the bid and the second one is the ask. So you are going to make a payment. Okay. Normally, what we do, we look at, if you have to buy, you look at the ask rate, which is always higher. But here the quote is not in terms of dollar, it is in terms of, it is actually given for pound or in terms of dollars. Okay. So that means you have to convert them. So do the reciprocal and find out what is the rate. $1 is equal to 0.64065. So you take 1 divided by 1.5609. So which will give you 0.64065. 1 divided by 1.5455. It will give you 0.64704. So now you have converted them into dollar quote. Now, what is the rate which you look at? You look at is the ask rate. So 3,64,897 into the ask rate, which is 0.6470. Okay. So you get, so that means you're going to get the money, it will be converted into pounds. So you're going to make a payment in pounds, which is the tune of 2,36,102. So this will be your outflow as a person in UK. So this is the money which will flow out of your country in terms of American dollars. Okay, so this is when you take a forward cover. But let's see a money market hedge. So since you are an importer, you're going to actually send money abroad. So what you do is you borrow pounds and invest in US dollars. So your money has flown out. In case of imports, the money has to flow abroad. So borrow in pounds and invest in US dollars. So borrow in pounds, that is the home currency, and convert the pounds into dollars at the spot rate and invest the dollars so that the amount grows to pay off the US liability. Fine. And the home currency loan plus the repayment of home currency loan repayment, which is the principal plus the interest, will become your cost of imports. Then you compare this with a forward contract and see which one is better to find out whether you use the money market hedge or a forward cover. So let's understand then. So how much should he deposit in dollars so that he can make an import? How much should he deposit in dollars so that he can make an import payment. The amount payable is how much? 3,64,000. So the deposit rate in US is 4.45%. So the present value would be, 3,56,000. So what we do is 3,65,897 divided by 1.025. So that means if he, deposits $3,56,867 for the period for 6 months, it will grow to 3,64,000. Okay, which is precisely his import liability. So he is going to deposit 3,56,000. Okay, fine. So the deposit rate is since this thing. So he is going to borrow this amount. So that means he needs to borrow this much amount in England. Okay. So borrow in pounds, how much? 3,56,000, because he needs $3,56,000. So he'll borrow how much? 3 lakh is equivalent to pounds, so that he can borrow and send abroad and invest there. So that grows out to pay the US liability. So the spot rate is 1.5617 and 1.5673. So we convert this into that quote, the desired quote, because the quote is in terms of how much 1 pound cost in terms of US dollar, but you want to know what is the price of dollar in terms of pound. So you convert that, and you have to find out what is the equivalent of $3,56,000 in terms of pounds. So you convert it in pound. So that means you have to borrow 2,28,512 pounds, so that you can remit 3,56,000 pounds, dollars in America, and then deposit, and then it pays off the liability in England, in America, for 3,64,000. So that means this much of money you should borrow in pounds. How much? 2,28,000. In terms of dollar, it has to be 3,56,000. In terms of pound, which you borrow, will be 2,28,000. So you are going to borrow 2,28,000 in your home currency, and then you have to pay interest also. How much? 7%. So that means interest at the rate of 7% will be 7,998. So principal plus interest which you have to repay to pay off your pound liability will be 2,36,000. So payable after 6 months will be 2,36,000. So now you have both the scenarios. How much you have to pay in terms of pound in money market instrument, as well as in terms of forward contract. So in a forward contract, it was 2,36,000. In money market, it was 2,36,000. Almost same, but we find money market payable is higher, forward contract is lower. So the company should take a forward cover, because here he is paying only 2,36,102 pounds instead of 2,36,510 pounds when we use the money market hedge. Okay, I hope it is clear. Okay, so now we are going to go to the external techniques, the forward contracts, futures contracts, options, and swaps. Okay, so let's talk about a forward contract first. Okay, a very simple one. So maybe 2 more questions we'll do before I'll end the lecture, and you can ask questions on the voice mode. An Indian importer has to settle an import bill for $130,000. The exporter has given the Indian importer 2 options. So you are an Indian importer, you have to make a payment of $130,000. Now the exporter has given the Indian importer 2 options. Pay immediately without any interest. Okay. Pay after 3 months with interest at the rate of 5% per annum. The importer bank charges 15% per annum on overdraft. Exchange rate in the market is as follows. Spot rate is given 83.35, 83.36 bid and ask rates. 3 months forward rate is also given. The importer seeks your advice, give your advice. So what you should do? Whether you should pay immediately without any interest, or the second option was pay after 3 months. So let's look at this question again. You are an importer. You have to pay $130,000. The 2 options are to pay the money immediately without any interest. The second option is to pay after 3 months along with interest of 5%. Now, when you pay immediately, in that case, you will be needing an overdraft normally, and the bank charges you 15%. Even if you don't need an overdraft, but you have to, when you to compare the two options, you have to actually invoke the overdraft charges. The exchange rate in the market is as follows. Spot rate is given and the forward rate is given. So let's do one by one. The first is, if the importer pays now, he will have to buy US dollar in the spot market. So he's paying immediately. He'll not go for the forward market. Okay. So what he'll do, he'll take a overdraft facility and the outflow will be like this. Amount required to purchase, 1,30,000 is the US dollar, and he's going to use the 83.36 rate. The rate is given to you, both bid and ask. So since you are an importer, you look at the ask rate, okay, which is 83.36. If you look at the ask rate, which is given at the top bottom, so it will give you 83.36. So the bid rate is 83.35 and ask rate is 83.36. So you're going to use this rate, okay. So amount required will be 1 lakh crore 8,36,800. So now since you have taken a overdraft from the bank, so you're going to pay interest to the bank, okay, 4 lakh 6,380. So the total outflow would be 1 crore 12 lakh 43,180. So this is the outflow when you're taking a overdraft facility and you're making a payment using the spot rates. The second would be that you wait and make the payment after 3 months. But when you have to wait for 3 months to make a payment, then you don't have to pay the overdraft charges to the bankers, but you have to pay 5% interest rate to the importer when you're importing. So you have to pay 5% interest rate, okay, on the import bill. So accordingly, he will have to buy the US dollar in the forward market. So you're going to pay the payment after 3 months, okay. So the amount of bill is 1,30,000. So you're going to add interest for 3 months. So which comes to $1,625. So that means you are going to make a payment of 1,31,625 to your customer, okay, and to your supplier rather. And the rate will be, you're going to use is the ask rate, which is 83.83, which is the forward rate. Okay, 3 months forward rate. So amount to be paid in Indian rupee after 3 months under the forward purchase contract. So you went to the bank and took a forward cover, okay, and you paid $1,31,625 at 83.83, which is the forward rate, and it translated into, in terms of rupees, 1 crore 10 lakhs. So the outflow, which outflow is more? The option number 1. So so you have to look at a lower option. So you're going to choose the option which is lead, which is the second one. So that means you're going to use the forward rate. Okay. So the forward rate was 83.83. So the 6 months forward rate, you choose that. So when you choose the forward rate, you found that you are paying actually lower than when you're choosing the first option, when you're taking an overdraft and paying immediately at the spot rate. So here you have to use the outflow is the least in the second option. That means when you take a forward contract. So let's go for the last exercise of the day. Let me see if you have any chat here. Such borrowing in Forex allowed? Yeah, definitely they allowed. If you can be a little bit more, elaborative, then I can answer your question better. Such borrowings in Forex is allowed. Now here, if you're referring to the current question, then here actually your supplier is giving you a credit. Okay, fine, for hedging. Yeah. Okay, so are you referring to the last question which we did, 1,30,000 US dollars, or referring to some other question? Now, in the last question, the supplier was giving you a kind of a credit for 3 months. So you're paying interest to the supplier. So you're not going to earlier techniques. Okay, fine. We're talking about the money market techniques, isn't it? Yeah, that is allowed, definitely. I don't have any kind of an issue whether it's allowed or disallowed. It's a free world, so everything is allowed. You can borrow in foreign currency. If you require any loan, you can either borrow in rupee or you can borrow in foreign currency. It all depends upon, your own this thing about understanding about which way the foreign currency is going to behave. Okay. So you have options to borrow in dollars or pounds, so which are called external commercial borrowings. So if you meet all the criteria laid down by RBI, so you can borrow. Okay. So of course you have certain kind of rules and regulations, but if you follow them, you can borrow. Okay, for business purposes, you have an underlying transaction, you can do. But if you're doing it for speculative nature, then of course the Indian laws can prohibit for the. But since it is, you have an underlying transaction of exports and imports to match up with your transaction, then the RBI is going to allow. Okay, fine. So let's do the last question before I'll open this thing. So let's understand that JK Limited, an Indian company, has an export exposure of Japanese yen. Okay. JK Limited, an Indian company, has an export exposure of Japanese yen, 1 crore Japanese yen, I suppose, receivable August 31st, 2014. Japanese yen is not directly quoted against Indian rupee. So you are an Indian company and you have an export exposure. That means you're going to receive 1 crore yen. When? On August 31st, 2014. Okay. So you have exposure in Japanese yen as an exporter. The current spot rates are Indian INR USD, which is 62.22. This is a pretty old quote coming out from your question paper. Old question paper. Japanese yen versus US dollar, which is given as 102.34. So that means $1 is equal to so many Japanese yen. And here, $1 is equal to so many Indian rupees, 62.22. It is estimated that the Japanese yen will depreciate to 124 level and Indian rupee to depreciate against US dollar. So if all this happens, it's not a good news for an exporter. He's going to lose money. Forward rates for August 2014 are given 66.50 and 110.35. So forward rates are also given and your own estimation is also given. Now required, calculate the expected loss if the hedging is not done. How the position will change if the firm takes a forward cover. If the spot rate on 31st of August 2014 are given as under. Okay, where the US dollar is 66.25 per $1 is equal to 66.25 and the Japanese yen versus dollar is given as 110.85. That means $1 is equal to 110.85. Is the decision to take forward cover justified? So this is the question which came in one of your earlier exams. So let's understand. So I've just made some boxes. So first, the current spot rate, which is given as 62.22 Indian dollar, dollar versus rupee. The dollar versus Japanese yen is given as 102.34. So here, $1 is equal to INR 62. $1 is Japanese yen. So since both are $1 Japanese yen, $1, both are European. So if both are European, then we can do it by division rather than first you have to convert the quote into the European and American, or you can just calculate by dividing. So here 62.22 divided by 102 will give you the rate of 1 Japanese yen, which is 0.6080. So this is the current rate. That means 1 Japanese yen is equal to rupees 0.6080. So it should be read as rupee or paisa 0.0680. But when you look at the expected rate, you find the rates are going to expected rate on August 31st, 2014. The rate is 65 and Japanese yen is 124. So that means 1 Japanese yen will be equal to so many rupees, which will be 0.5242. So the Japanese yen has actually depreciated from 0.60 to 80 to 0.55, from 0.6080 to 0.5242. So big loss as a exporter. You're going to receive 1 lakh crores of yen. So, but when you look at the forward rate, you find, in forward market, it is giving you a much better rate. Look at the last bottom, it is 0.6026. So you would like to go for a forward contract because the rate in the forward contract, US dollar is 66.50 and Japanese yen has actually gone up to 110.35. When you convert that, so you'll get a forward rate as one Japanese yen is 66.50 divided by 110.35. So which means the rate is 0.6026. So it will be better to take a forward cover rather than looking at this expected rate. So by going by the expected rate, the company should go with a forward contract. So now, if the company doesn't go for a forward rate, then the money will be received as per the spot rate. Or you can compare the forward rate and the spot rate and find which was the better. So in the spot rate on August 2014 gives you a rate of 0.5977. Oh, it is good that you have covered yourself in a forward rate. So if you've taken a forward cover, then you will be always better because the spot rate is not giving you, giving you a loss compared to the forward rate. So let's now see. First is when you compare the expected rate versus the rate which is prevailing at the time when you did the transaction. So the rate at the time of export was 0.6080. So you would have got 60. Have you got the money immediately? At that time you would have got 60 lakh 80,000. But the expected payment was to be received on 2014. So you would have suffered a loss of 8 lakh 38,000 if your expectation would have materialized. But suppose you're using a forward cover, you're not losing much. Okay, because the yen has depreciated in all kind of situations, but it's a least in the forward cover where it is 0.6026. So that means the total loss to you would be only 54,000 if you take a forward cover. But if you don't have taken a forward cover and you would have got the money as per the spot rate, you would have suffered a loss of 1,03,000. Because at the time of export, you were supposed to receive 60 lakh 80,000, but the estimate payment to be received on August at the actual rates. Okay, so this is basically the actual payment, not the estimated. So actual payment you received at the time of in the spot market would be 0.59. So it will be 59 lakh 77,000. So that means you would have suffered a loss of 1,03,000 compared to what the rate it was at the time of your export if you are not taken a forward cover. So if you are not taken a forward cover, you have lost 1,03,000. If you're taken a forward cover, you have lost 54,000. If your expected rates would have materialized, you have suffered a huge loss. So better take a forward cover and save yourself from a huge loss. Don't wait for the actual rates to happen. You would have suffered still a loss, made a loss of 1,03,000. So this completes the today's lecture. So if you have any questions, you can ask me. Let me see if you have any questions on the chat line. Okay, so I don't have any questions. Mr. Ajit, can you just put me, if any student wants to ask any questions, he can ask now. I'm just keeping 15 minutes window open for any students who are listening to the lecture. They can ask the questions.
Good morning, sir. Abharakesh.
Yeah. Hi, Abresh. Yeah, tell me.
Hello.
Yeah.
Sir, Abharakesh.
Yeah.
Hello.
Okay. Tell me.
I'm audible?
You are from which place you're calling? You're audible, absolutely.
Yeah. Sir, my question is regarding the internal techniques of hedging, and particularly leading with respect to leading.
Yeah.
Now, as you, leading techniques requires to make prepone the payment
Yeah.
when we are importer.
Yeah.
Okay, so it is not possible that in practical life we may have a risk of non-supply of material if we make the advance payment, and then the supplier may not even supply. So how to take that risk?
Okay, so that's a very good question. Here we are not referring to the situation We are referring to the situation that you are an importer, you have received the goods in your country. Now you are getting 6 months time to make the payment. Okay.
Okay.
So now, since you have got the goods in your hand, so there is no
Okay.
risk that you will not receive the
Yes,
goods.
yes. Then
If you have not received the goods, then it's a different story. But you have received the goods and you have
okay.
some time to make, so then you can make a prepayment. Okay. So in that
Okay.
situation, there will be no risk.
Okay. Thank you, sir.
Yeah. Avresh, from where you are, which part of the country you are?
I am from Ahmedabad,
Okay, very good.
Gujarat.
Good, good, good. Any other person, please? You can ask questions. Any other questions? Rakesh, Avresh?
Not from me, sir.
Okay, okay. So I'm just waiting. If you have any questions, you can ask me. Have you understood today's lecture? How was it? Did you? What was your reaction,
Yes,
Rakesh?
sir.
You
Yes,
have understood?
actually, I mean, this subject is very complex.
Yeah,
Forget about hedging, swap. Even the foreign exchange mechanism is also a bit difficult because
yeah,
particularly when we don't have any exposure in practical life.
yeah.
But yes, many of the I mean concepts clear to me now.
Okay, very good. No, no, it's a very, very, as you said, it's a very complicated subject, and without having any adequate exposure, practical exposure, you're just learning theoretical, part of it, and you're trying to, understand the concept through the theory rather than, having any practical exposure of handling those transactions yourself in the forex market. You
For
know,
me, this is academic only, sir, because I am a retired person. I'm senior citizen.
okay, senior citizen. Okay,
Just pursuing for sake of clearing the CA, which I have taken up as a target.
okay, very good. So you found that it was you were able to understand what I've explained.
Yes, yes, sir.
Okay, wonderful.
Very well.
Yeah, one very good, very good. So because this subject is very, very the most complicated subject topic in CA final, and a lot of people make mistakes. Even the people who are experts or the expert academicians, without any having practical exposure or really working. I mean, with theory only you can't understand all the concepts.
I
Only thing
agree, sir.
because, yeah, since I have worked with many companies in my life, in 5 or 6 companies like Reliance, Vodafone, and I mean SRF. So I have practical exposure and understanding about how these things are met there. So I have seen everything happening in front of my eye. Okay, and that's why it gives me an added advantage. Okay.
Even, sir, in I mean, very I mean, in regular transaction, making payment or balance payment of LC or anything. I mean,
Yeah.
if you make a mistake in deciding the which currency you made advance payment and which payment you are making final payment, there
Yeah.
also there are I mean likelihood that company may end up ending in loss. Excess
Yeah.
payment, I mean.
Yeah. Yeah. Absolutely. Good. Your observations are absolutely right. Mr. Ajit, are you there? हाँ हो गया. I mean, we are finished. I think I have asked students if they have any questions, but I have got a question from one of the student.
Mhm.
So there's no other question. Can we end up the session now?
Yes, sir.
Okay. Okay, then see you on next day, that is 14th, with the balance topics. Okay. See you. Bye.
Thank you, sir. Bye.
Bye.
Thank you, Ashok ji. Just resolve my issue of not getting a Zoom link on, I mean, Zoom connection on my laptop.